Welcome to another edition of Around the Table with Stacy Smith. We are now heading toward the end of the year, which is a time always to reflect on what has happened in the stock markets and the economy and what may happen in the next 11 days. If you are invested in the markets, either through your 401k or your IRA or just an investment account that you might have, it might be a good time to take a look at where things stand. To analyze what is happening, I'm going to introduce you now to our group of outstanding analysts, and they are Carrie Coghill. Carrie is the president and CEO of Coghill Investment Strategies, which is headquartered here in Pittsburgh. She is recognized as one of the nation's leading voices on financial advising. And as we go around the table, we find Frank Brissetti. Frank has been advising clients for 50 years. Frank helped to establish Harvest Financial, where he is the executive chairman. Across the table, we find Kim Forrest. Kim is the Chief Investment Officer and founder of Boca Capital Partners. Kim has a dual background in both finance and in software engineering, and you may have seen Kim in her many appearances on CNBC, Fox Business, and also on Bloomberg. And our last panelist at the table is a name familiar to a lot of people here in Pittsburgh, Bob Fragasso. Bob has been in the investment advisory business for nearly 50 years and is chairman and the Chief Executive Officer of Fragasso Advisors. So let's talk about something here, and that is this. There's always a lot of talk about a Santa Claus rally at the end of the year. My very unscientific research of the last 21 years shows there is something to that. Now, overall, in the last 2 weeks of December, the average gain in the Dow for those 2 weeks is roughly 135 points. There were 16 years where the market had gone up, 5 years where the market had gone down. Now, the up years show an average gain of 306 points. The declining years show a decline of 286. I should add this, though. The declining years, the down years, are skewed a little bit because in 2018, the Dow lost more than 1,000 points in the last 2 weeks. So that begs our question. Where are we headed this year? Is there a rally or is there a decline? So Bob Fragasso, I'm going to start with you. Your quick analysis of where we're headed. Is Santa Claus still coming to the markets?
I applaud the research you've done and putting the odds in favor of a Santa rally. However, the market's direction is motivated by a lot of factors, not just one. However, the statistical probability might indicate. For example, right now, will the Build Back Better plan pass? And will we get almost $2 trillion infused into the economy? That'll have more of an effect than a potential Santa Claus rally. And so in deference to Santa, I think we have to look at a more holistic picture. Another point is no one should attempt to time markets. So if we talk about a rally, we might be spurring people on to try to jump in now because you're going to take advantage of Santa's rally. And that is, over the last 50 years, I've interacted with people nationally, experts nationally, and nobody has been able to do that successfully. Chasing that is fool's gold. And you might be able to do it once, but that would be lucky. And there are no chapters in the textbook entitled Pure Dumb Luck, so we don't want to follow that. I would say that to answer your question, the overall direction of markets seem to be, and there's no guarantee of the future, seem to be upward. It won't be unendingly upward. It'll fluctuate. You can't call those fluctuations, so you have to ride through them. But I'm favorably disposed to the upcoming year. The end of this year, it'll go up or it'll go down. Yep. But I think we have to look intermediate term.
All right, good. Kim, your take on it.
Sure. So I love watching markets, but I think they can only reflect one thing a day. And for better or worse, today, the markets are going, OMG, Omicron, and that's not a good thing. But I do think there's a bias at the end of the year that people are happy with how well the markets have done, and it might drift upwards if we could get our mind off of Omicron.
All right, good. Frank, what do you think? Santa coming?
The market is an incredibly emotional thing, and as Kim was talking, the resurgence of the new variant of the virus is playing with people's emotions quite a bit right now and causing the market to sell off. Add to that last week's lead by Chairman Powell that the stimulus is going to be reduced at some rate. The market initially thought that was less than he could have done and liked it for a day, and then the day after that, that didn't like it. And I will say that the rising interest rates are never, in the long term, good for the market. Short term, maybe small rises shouldn't matter too much, which is all they're talking about so far. But if the virus gets us going, the economy slowing down, they probably won't raise them at all yet.
All right, Carrie.
Well, the idea of a Santa Claus rally really speaks to the seasonality of the markets. And we know that there are various months where the market generally does better than other months. And I think that one of the reasons why we tend to get this rally really has to do with volumes in the market and trading, and are people really trading? This year, because of the resurgence of the pandemic, the troubles that we have in Washington and getting this Build Back Better bill passed, that reduced volume really could lead to more of a downside than an upside, given the dynamics that we're dealing with. But regardless, for long-term investors, whether or not we have a Santa Claus rally really is irrelevant to their portfolios.
It's too short term, is basically what you're saying.
Exactly, too short term.
All right, Kim, I'm going to bring you back in again. As we've just mentioned here, several factors at work: the resurgence of the COVID virus, inflation, and word from the Fed that it's looking at possibly increasing interest rates as many as 3 times in the coming year or so. So let's take a longer term look. As an investor, should I be concerned about these things?
I don't think you should be concerned, but I think you should be aware of each and every one of those things. And then this is what I think you should do, or you and your advisor should do, is have a longer term perspective than a year. If you can, it's not market timing, it is market opportunity. On some sell-offs like that's happening today, if there are stocks that you know you want to hold for the next 3 to 5 years, I would encourage you to take a look at them and see if in any of the scenarios that you just laid out, inflation, COVID continuing, dysfunction in the government, how affected are those stocks going to be? And then you might want to buy them, on these sell-offs. So I think the markets are always going to react to news. It's how you react and invest. That's the important thing.
Okay, Frank?
The markets are, quite frankly, in my opinion, over the long term, going to rise, period. I am a firm believer that the world economy will continue to evolve and create growth opportunities. Things will change as they are now. We've been going from a manufacturing to an information society for the last 30 years or so. That's continuing. It's getting more esoteric, if you will, because I didn't understand it before, and I'm totally clueless. Kim will have to help me with that. And it's needless to say, I'm trying to not let it pass me by, but it's running pretty fast. And I think that will create growth opportunities in industries as we go forward that will allow people to make money. And I think that will go on indefinitely.
All right. That's your take on this. So let's go to Carrie.
Well, when we look at everything that's going on in the markets these days, whether it's inflation, whether it's the Federal Reserve, the variant, it is really important for long-term investors to understand the dynamics of how these things influence the market. And although we don't want to be letting the market or have market timing, we do want to be smart and tactical about how these things affect the market. So for example, last week, the headline is all about the Fed's raising rates 3 times. Well, that's not what he said. What he said was, if the data supports the decision to raise rates, we could possibly see 3 interest rate increases. So now with the increased variant and the possibility that we may actually see growth slowing, the likelihood that the data points that the Fed is watching to raise interest rates, the likelihood that those point in that direction may back off. So as we look into next year for our clients and for the sectors that they own, we want to make sure that we're positioned in sectors that are not going to get hurt if we see those interest rate increases, but we're not going to overreact and get out of all the positions that would be affected. So that's really our job as advisors, to understand when we should be rebalancing portfolios.
Are you telling me that perhaps the media might have over-exaggerated something? I can't believe
It's
that would have ever
amazing.
happened.
As a person that watched his news conference and reads all these headlines, I'm like, were they watching the same press conference I watched? It doesn't seem that way.
I happen to agree with you. That happens a lot. So, Bob, I have a feeling you might be agreeing with what Carrie had to say in relation to taking a longer-term look here.
Yes, I'm agreeing with all three of my colleagues, and there's no need for me to repeat what they said. They said it well. And I would suggest that in terms of timing, the COVID virus will be handled. We have 65% inoculation in this country. If we can continue to creep up, it'll become like the flu, and it won't be something that is going to be so pandemic-like on an annual basis. Inflation, it seems as though that will become tamed as we get into solving our supply chain problems. We're going to have inflation. We're supposed to have inflation. We're not supposed to have deflation. That's anathema to the economy and to our well-being. Interest rates, we should only be concerned if interest rates start to edge out of the norm. The Federal Reserve will move interest rates, maybe not 3 times next year. They'll do it, as Carrie said, as the data indicates. But interest rates will go up, and they will regress to the mean, as the mathematicians say. They'll become more normal, which is for intermediate to longer term rates, 3 to 4%. If it starts to break out of that, we should be concerned. And that's where you don't jump out, but you look to, again, as Carrie said, the positions in your portfolio to see which of those will benefit, which might be hurt by that. And finally, I would postulate that a normal range of interest rates will be good for markets. It'll slow the pace of growth over time to make it more plannable, and it won't be so much like a roller coaster as a result.
All right. Now, Frank, after your response and everybody else's response, I probably shouldn't ask this question, but for those who might be thinking about this, your quick take on this as an investor, should you put your money, where should the investor put his or her money, do you feel, in the next several months? My basic question, is it time to take profits? Is it the time just to stay put? Is it time to move it around in different areas, or maybe just even go to cash?
Well, everyone that listens to this, watches this show, should take everything any of us say with a small grain of salt and apply it to their own circumstances, and go to their own advisor to make sure, their trusted advisor, to make sure that it is suitable for them. So to answer your question, we believe it's time to take profits when the reason we made an investment no longer exists. If we bought a company or a strategy or a market because we thought there was a lot of growth in that arena, and the market either drove those investments way beyond where we think that growth was going to take it, we would consider taking profits. I wouldn't do it because that some index was up or down. I would do it because the specific investment had moved to the point where it was a little overvalued, a lot overvalued, not a little. Because after you pay taxes and trading costs and everything else, you have to be careful with your activity. That being said, no, I don't think it's a time to cut and run. I think it's a time to own securities. Earnings, as Kim loves to say, are exploding. And if they just slow down to a normal 5 or 10% rate, this market is not overpriced.
All right, Carrie, what do you think?
The question to take profits, go to cash, add more money, all of those questions are dictated by an individual's personal strategy. And the reason why is that we all have different levels of risk tolerance. We all have different tax rates. There are different tax implications to decisions that we will make. And I think the most important thing that we have to realize, especially when people are considering getting out of the market, is that getting out is the easy decision. Getting back in is the hard decision. I know people still in cash from 2008 because the signals never go off. So a question like rebalancing or like going to cash, there's a difference. If you have a plan and you have a strategy and you know your risk tolerance, you can easily make those decisions about the timing of rebalancing. For someone that is just out there playing the stock market, there's no answer. It's a gamble.
Okay, thank you. Bob?
Terry and Frank made the point from two different directions. They're both correct. You can take profits in individual securities when your fundamental analysis shows that the stock may have run past its anticipated earnings over the next few years, and then redeploy that, again, considering the taxes you might have to pay in selling and rebuying, redeploy that into something that hasn't gone that way. But trying to decide that the overall market is overvalued, once again, is not a productive endeavor. Having said that, you can make decisions in areas, geographic, industries, themes where you would want to concentrate more. And once again, as my colleagues have said, you work with your trusted advisor. You don't think it up over coffee at Panera's. This is an analytical exercise. And if so, we are featuring US concentration, not getting out of the international, but looking at the US. And one of the reasons is we have now started to move, and we talked about this in past panel discussions, toward onshoring, or at least on-continenting our continent, our supply chain. And that bodes very, very well for jobs. They may be right over the border in Juarez, but the supply chain reaches right into Pittsburgh as a result. So look at the jobs that'll be there, the industries, the companies, and have your advisor and you do the analytics. Then you make informed decisions. But we are favoring the US, but not leaving the rest of the world out of our portfolios.
All right, Kim, what do you think?
I'm going to address that go to cash question because people ask it all the time. And I always give them this analogy. Do you drive your car with your foot to the floor at all times, like gas, brake, gas, brake? No. And you probably shouldn't run your portfolio that way either. So yeah, unless there's something unusual happening in your life, you might think it would be a great idea to go to cash, but please don't. Please reconsider, talk to somebody that you trust that knows your financial situation. The other thing that I'd like to talk about, because I'm more of a portfolio asset manager, is look at the weighting of your stock. If you have one company that's done really, really well and is over 8% of your total holdings, I'd use some opportunity to pare that back. Because even though you really like this company and it's doing well, things happen. Bad things happen to good companies. So you really have to watch. So that's my bit of advice, is look at the percentage weightings, maybe take some money off the table that way by paring them back and then redeploying that money. But please, whatever you do, don't go all to cash because you're nervous. Don't.
Oh, okay, I'm going to ask this question, a quick response from each of you. And since you're on right now, Kim, I'll ask you.
Okay.
Is there a percentage basis that an investor should be looking at when a stock goes up? I mean, is that how you would analyze this, or is it based on other kinds of some sort of fundamentals?
I'm just talking about the raw appreciation, right?
Right.
So if something is more than this is what I use, 8% of your portfolio, it can really impact your portfolio if some news comes out and cuts that in half. So take a look at it if it's 8% or more, and then walk it back. Now, it depends. The absolute, like, is the stock overvalued? You have to look at that on a case-by-case basis. And I like to use close comparables as opposed to like what a company is trading at, the multiple with respect to the market. Who cares? You have to look at Like if you're looking at Apple, look at other consumer electronics companies, computer companies for that multiple, as opposed to what the market's trading at.
Okay, Bob, your thoughts on what I asked?
I think that there is no way to determine a percentage movement of a company. That's too one-dimensional. So if you're analyzing, or your advisor is analyzing the earnings, the future earnings, the prospect of a company, then you can do a mathematical exercise to see what the outer reach is so that it doesn't get ahead of its skis. And at that point, you get into what Frank talked about being overvalued. So there's no separate, if it goes up 10%, start to sell. Kim was talking about not having more than 8% of your portfolio in one stock, different percentage calculation. I want the listeners and viewers to understand. There's no percentage that you can say, okay, it's now time to sell because it went up X percent. It's rather, is it fulfilling its earnings expectation? Now, your point, Stacy, is let's suppose, Kim said it, bad things happen to good companies. Let's suppose there's a hit, you know, the famous Tylenol thing that they pulled the Tylenol off of the, that's not the time to sell. Analyze it. That might be time to add to your position. So everything stands on its own with individual analytics. There can't be, I wish there were easy rules of thumb. The markets don't work that way.
They don't work that way. Carrie, you would agree with that?
I take a little bit of a different take at that. I think that it's a lot more client centric than just where are the percentages. And, you know, I have numerous clients that have done very well in certain individual stocks and, you know, represent a higher position that we would normally hold, but knowing those clients and understanding their risk tolerance and understanding the tax consequences of actually paring those positions back, you know, we may decide to let a position run higher because we know that client, and in another portfolio, same position, we may pare it back because we know the client isn't going to be happy with that overweighted position driving volatility. So, you know, this really gets back to the planning question and understanding the risk characteristics of the position, but also the client and how taxes feed into that. And that gives us the opportunity, quite frankly, especially at this time of year, to do some really interesting things from a tax perspective. Can we gift some of these shares to a charity? There's all kinds of different estate planning techniques that we look to utilize when we have positions that have done very well, but yet the client doesn't want to take a tax hit and doesn't want to keep that volatility in the portfolio.
All right.
Would you give me 15 seconds real quick?
Absolutely.
Agreeing with what Carrie said, but I want to make a distinction. Simply because a client is comfortable and wants to hold a position, and I know you didn't say this, Carrie, is not a reason to allow them to be overweighted. The disasters I've seen over the years were when somebody held that position and then it got hammered. So you do have to pare it back if you're overweighted regardless. I could say, I love my cigarettes, doctor, don't tell me to quit. The doctor has an obligation to tell me to quit. So if I'm grossly overweighted in a position, the advisor has an obligation to advise to pare back.
Okay.
And that's where the communication comes in with the client. And I think sometimes, you know, that's overlooked. How much volatility it ultimately to sit down and let a client know, look, here's what we're faced with. Here's the volatility. Here's the thing that can go wrong. And Kim, to Kim's point, you know, we always use the Tylenol analogy because that's the one that kind of people remember and it sticks out in their mind. And it just gives us an opportunity to do further, really, estate planning and tax planning.
Frank, I'll let you wrap it up.
Well, everyone is saying different things that need to be tied together. We're looking at investment decisions based on fundamental activity within a company. We're looking at hold decisions based on how large that position is in a portfolio. We're looking at positions that are maintained because of attitudes and tax situations. We're looking at maintaining long-term focus rather than short-term reaction. All these things are what we do with our clients every day, and they all have significance to our positions and what we keep and what we don't keep going forward. And I can't add any more to the conversation except for trying to tie it together.
Okay, well, thank you. Now, there are a lot of analysts out there who do believe we are due for a correction in this market. It's been a bull market for some time. A correction normally means around 10% or so of any particular stock, I believe, or necessarily the indices. So, Carrie, with the thought that there might be, and it's a big if there is a correction longer term, what would be your advice for your clients?
I mean, the advice to clients when we are experiencing a correction is not to sell. The idea of how you're investing and having a strategy, we could any day of the week have a correction. We could wake up one morning and get some news that puts us into a correction. The best way to avoid a correction is to have a well-managed portfolio that you're constantly paying attention to. And you don't want to be reacting emotionally by selling into weakness, because we know the largest up days in the market come immediately following the biggest down days. That historically has been a pattern. One of the things that I would advise investors to do continuously, especially when we have a market that has some volatility, is just make sure that your shorter term cash flow needs are satisfied so that you don't have to sell into a correction.
All right. Thank you. Let's go to Bob.
That was perfect, Carrie. That's I won't try to repeat it. That was great. I would just add that normal corrections are not to be feared. As an example, 10% or more. The early part of 2020, we had a very sharp correction, but yet, as Carrie pointed out, we recovered in the second quarter. And we continue to go up from there. And you can't call that. I had someone say who wanted to go to cash, We manage on a discretionary basis, but this person wanted to go to cash. And he said, but you'll tell me when to get back in. I said, I can't tell you that. Yeah, you see the point. Nobody can tell you that. So don't fear a normal correction. As long as you're allocated properly, your choices are right, you're not overweighted in any companies, you can sail through a correction. As again, Carrie pointed out, have enough cash to meet your daily and monthly needs. Then you can sit back and enjoy the ride.
All right, Kim.
I think correction calling is one way I can spot somebody who doesn't really know how markets work, because it's not a time period. It's not like, it's not seasonality. It's more like earthquakes. We don't know when earthquakes happen. They just happen, right? For whatever reason that's happening underneath the ground. And that's the same thing for corrections. It's that final thing that throws panic into the streets and into Wall Street. But we don't really know what it is. And I think you must really be cautious if you're reading investment newsletters or even articles that are saying a correction is due, here's when it's going to happen, here's what's going to happen, because nobody really knows. Sorry.
Okay, Frank, your final thoughts on this one.
Well, I don't know when corrections are going to happen either. There was a time in my career I thought I was right. In fact, I was. And about half of my clients listened to me and pared back their positions and got the cash. And then I was right again when it got near the bottom. And about half of those clients listened to me and got back into the market. And I've never done it since, for the simple reason not even in baseball was 25% good, which is what that turned out to. And I was right. So the clients that didn't listen at all were okay. The clients that only listened to half, I hurt. And the other 25%, we really did well, but so what? My batting average was not good enough to continue to take that approach. And I was actually right, which I'm not sure can happen too often. As Bob likes to call, there's no chapter about dumb luck. Right. I don't think mine was that dumb. It was pretty fundamental back when the .com thing came. I mean, we were all working then. It was pretty easy to see coming. Today, I would do it differently. I would
that's a perfect example, Frank. Stay out of the junk. stay out
Pardon me?
of the junk during things like the.
Yeah, get out of the
Then you won't
high
get
price
hurt.
stuff and get into low price stuff and don't take that risk
Right.
of not getting back in, as I think Carrie said right from the outset.
Right. All right. Well, it's time now for our weekly stock pick. Kim is the only one of our analysts that can do this by legal reasons for the SEC. So, Kim, you've made 4 picks so far. Here is where things stand as of Friday's close. Xilinx is up 29%. VF is down 5%. J&J is up 5%. And Morgan Stanley, your most recent choice, is down 2%. So what is your stock pick for this week?
Sure. So everybody has to go to their advisor and, understand what their risk tolerance is. I'm going to talk about Micron. The ticker symbol is MU. And yes, it is a tech name, but it's trading at a relatively tame 16 times forward earnings. What it does is it makes 2 different kinds of chips, one of which is the things that are in our phones it's kind of like static storage. It replaces a spinning disk drive. Why do I like this? Well, because I think there's going to be way more data created in the world, and it has to go somewhere. And Micron is going to be a company that helps people store it. So again, this is a very long-term pick, 3 to 5 years. While I do enjoy that Xilinx being up 29%, that's a fluke. Sometimes you just hit it right.
All right. But you would stay in Xilinx right now.
Oh, heck yeah.
Okay. All right. That's good. All right. Kim, thank you. Carrie, thank you. Bob, thank you. And Frank, thank you. I wish you all a Merry Christmas. And how about this? So the next time we get together at the beginning of the year, let's take a look at where we think the markets might be headed in the coming year. If that's all right with all of you, we'll do that. All right. Thanks again, and we'll see you soon.
Happy holidays.
Happy holidays.
Bye-bye.